You buying property in Dubai from abroad? Great. But let me be straight with you. That excitement you feel, that vision of high returns and beachside investments, it can turn into regret real fast. Because most foreign investors, even the smart ones, make brutal mistakes that cost them hundreds of thousands of dirhams every year. So, if you're a foreign investor, in this video, I'm going to walk you through the real high-cost traps to avoid when buying from overseas. And if you stay till the end, I'll share a bonus that could literally save you time, money, and all the headaches. Especially if you're planning to relocate to Dubai or opening your business in here. Smash the thumbs up button and let's get into the video. Mistake number one, and that's a very important one, is not understanding the currency exchange. Most people think they are investing in real estate, but they are actually gambling on currency risk, especially from abroad. If you're buying in AED, but you're funding your investment from euros, pounds, USD, and so on, the exchange rate movement can really easily swing your entire investment return. Except the US dollar, because the AED is pegged to the dollar, so anything that happens to the dollar will basically reflect into the dirham. Other than that, you might be in a serious trap that you might not even think about, but it could cost you quite a lot of money. A 5 to 10% drop in your currency or a very poor transfer rate that you use with your provider, that's your yield wiped out instantly. I've seen clients celebrate 10 to even 12% ROI to only discover they just broke even when transferring back home. You need to hedge if you're transferring large amounts or time your transfers wisely. But most important, factor your FX risk in your projections. And another important thing, use really good providers. There are plenty of them, from Wise to PaySense, to send amounts of money to the UAE without paying too big of exchange rate delta or any kind of transfer fees. That leads into mistake number 2, which is ignoring the transfer fees and the closing costs. You see the brochure price or what the developer or the agent tells you, but that's not really what you pay. I've mentioned this in many of my videos, but let's wrap it into a quick breakdown of what you will actually pay. 4% DLD transfer fee, trustee office charges, agent commissions of around 2%, NOC fees from the developers, and so many more fees if you're financing, such as the valuation fee for a mortgage. All these costs add up and pretty fast. And if you are doing this, for example, financing, and you're planning to actually close it in a few months just to make some return on your investment because the price of the property might increase and you can't really finance it fully right now, well, think twice and think properly, because when you close that investment, you'll still have to pay a couple of other fees, and that could actually eat up your margin. Budget 6 to 7% over your property price, just as a side budget to avoid nasty surprises. Of course, that's before all the buffer that you have for emergency funds or any kind of life situation. So just have around 6 to 7% besides the planned investment cost to know that you're basically safe and you will be able to cover anything additional that might come up. Know your all-in costs, not just the sticker price. On an honest note, I was also really ignoring these transfer fees and especially the exchange rates, because when I got my first off-plan from back home in Dubai, I got it actually remotely. And when I was transferring the money for the deposit, I actually didn't think that I might be really charged. Besides the FX, which wasn't really good because I was just transferring from my own bank account to the developer, there was also some implications with the fees, because there was basically some fee to receive it in the UAE. And also, if you're transferring from your own account back home to your other own account in the UAE, if you already have one, then also make sure that there won't be any incurring charges, because most of the banks actually apply them. So for example, you might transfer yourself $10,000 into your account in UAE, and there will be an incurring charge of around 2 to 3%, which is quite significant, especially if you transfer more than even $100,000 or so. Another mistake that I really often see that there's no clear exit strategy, and this really is strange. And it surprises me even more when there is no strategy for the off-plan investments. I can't stress this enough. It's so important to know how you're going to exit before you buy. And by exit, I don't mean the resale only, because many people will think that this is just basically a plan on how I can resell after, flip it or whatever, and make some return on this. It's also about the rental market, the opportunities that are in that specific area where you bought, maybe in that specific tower even. So ask yourself, are you planning to flip before handover, renting out for long-term cash flow, refinancing later through equity release, and if that's even possible to your case? Most investors don't even realize that some projects and even developers, they have rules that don't allow you to resell your project or your unit until at least 40 to even 60% of the payments are done. Most of the banks won't finance the off-plans before handover. And of course, not all off-plans have any resale demand. That's how some buyers get stuck. Ask yourself, what happens if I need to keep this unit longer than I expected? Can you finance it? Can you rent it out? If not, perhaps don't buy it. Plan your Dubai trip properly before you purchase. You fly in for 3 days hoping to finalize everything and purchase your unit within this time frame. I've seen it over and over. Buyers rushing into the off-plan launches, pressured to book something or pay for something right away for something that they have barely viewed or reviewed. Here's what happens. You visit too few projects, you miss out on key neighborhoods. You get emotionally sold by a Polish sale center, which sometimes is super appealing. Also, finalizing this deal might take longer than you expect. Some units might be allocated before launch and you need to wait a little bit to see maybe your unit, the one that you actually really desire, might get canceled from another booking and you can actually grab that one. So don't rush into what's available now, or at least what the agent tells you that is available right now, because there are so many units that will just come back to the market because there are so many interest of purchases placed down before the launch and then they basically cancel on them. Give yourself time, ideally 7 to 10 days. And if you can't fly in right now, or you're really interested in a launch and you really can't be there, work with someone who is locally present to vet this for you objectively. If you're unsure in the agent that you're working with or just the person or friend who is looking into that for you, then definitely ask around, ask more agents, ask more people who are external to this project or developer. Like myself, I'm also an investor, so I don't have anything to do with any developers, so I can tell you what I objectively think. But ask around. Maybe you have friends. Maybe you can even ask agents that are not even affiliated to that project to tell you what do they think about it. That leads to the next mistake, which is not researching the area properly. This one's critical because photos lies and brochures are usually very flashy. Sales reps are exaggerating and they are really cherry picking. You need to understand what's actually around that building. Is anyone even living there already? Noise levels, access, traffic, and so many more things that you really need to question before you sign any kind of deal. Other important things is whether there is construction that will kill your view in the future. That's super important because you're always paying more for a good view unit. Of course, in an ideal world, you will fly in and scout the area yourself. But if you're not disposing of the free time to do so, or is just really ad hoc, then just find someone external and neutral to the project, to the area, who can actually go in, investigate it for yourself, and give you some report. You can even pay for that. Mistake number 6 is not understanding how the rental market actually works. Most foreign buyers assume that you'll get a tenant immediately. It's Dubai, so everyone wants it. that the management is passive and that the ROI projections actually match the agent's projections, which is just BS. Here's the truth. Vacancy risk is very real. Property managers take 5 to 10%, and not all of them are reliable. And that's not even on Airbnb. That's on long-term rental. If you want Airbnb, then that's a different story and way higher interest that they take, or percentage, as in from the annual return. You'll pay fees for DEVA setup, a JARI registration, setting up all your additional utilities. That's all additional small costs that you really need to look into and understand how they work properly before you rent it out. If you're foreign, you don't know the market. For example, one could be that you're actually the owner of the property, you rent it to a potential tenant, and you actually need to also set up your utility deposit, not just the tenant. Finally, annual service charges can also drain your pocket, so you need to look into that as well, as there is no one single benchmark for all the areas, and some areas are really, really expensive in the service charges. So as a tip, set your expectations, bet on the net annual return, not the gross rent. Ask about historical occupancy if it's a ready unit, or historical occupancy of the area and the other projects that are similar to the off-plan that you're buying into. Tenant profiles as well. It would be quite interesting to know who is actually the potential tenant in the unit that you're buying in, and also check the true cost of management. The Dubai property market is regulated, but it's important to know that it's very different from many systems that the foreigners are used to. It's nowhere near to the European systems or any of the other Asian markets. You need to know how DLD or Dubai Land Department works, what the Okud is for off-plan, the difference between freehold and leasehold, of course, what documents are needed for registration, title deeds, and mortgages, how to avoid delays in NOC issuance, transfer timing, or registration errors. This actually happens quite a lot, and even small mistakes in your names won't allow you to log in to the official department websites. So that's a very important one. That's why we always cross-check the legal documents before the client signs into a deal. If this sounds complex, well, that's because it kind of is. So it's not really hard to manage, but you really need to understand and learn this properly, or have someone to guide you into how to do it properly before you get with your investments and add more to your portfolio. Another big mistake that I see from my clients is not structuring their investments and their entities properly when they want to also either relocate to Dubai or set up their own businesses in there. This is a huge one that no one talks about. If you plan to move to Dubai, set up your company there, start your residency journey while also investing in property, then your property purchase shouldn't be separate from your tax planning, business structuring, or residency setup. I work with clients on this exact thing. It's part of my Dubai setup advisory package. We look whether you need to buy under your name or under your company's name, how to set up the company right. Is it a free zone? Is it a mainland? Which visa and license makes the most sense for you, not only when you look at property and residency, but also for your tax implications. And of course, how to align your property investing with your long-term UAE journey. This saves you taxes, legal issues, and future headaches, and of course sets you up for a very good future, stable and well-planned in the UAE. If that's something that you're planning for or already thinking about, then don't hesitate. DM me the word setup on Instagram at Alex Gorasov, and I'll share what I'd recommend based on your situations, and hop on a call with me and discuss this in more details. Another big mistake that I actually recently started seeing is that so many foreign buyers are actually ignoring the actual project they're investing in, but they're going with the developer's name and reputation. Buyers think, well, that's a big developer, sounds like everyone likes it, it must be good. Not true. I've seen great developers put out terrible projects, at least terrible in terms of ROI. They might be really nice for living in there, but they won't really be desired by tenants, or the market could be really slow in that specific area, and you might get the alert that this is a great developer. It will definitely give you that ROI, but it won't. Wrong locations, low rental demand, overblown service fees, and very low liquidity. Judge every individual project by itself, not just the logo. Look at location performance. You can use the XB Interact for this or any other websites that show you this properly. They all extract the data from DLD website, which is the official governmental website, so you can actually trust it. Also there, look at past resale data for at least other projects in the neighborhood, so you can understand what to expect from this specific project. Layout, service charges, views, obstructions, if any, and the actual rental demand in that micro location. I usually even look at the most neighboring towers to see exactly what I want to expect or what I shall expect. Finally, underestimating the true cost of vacancy. That's a big mistake. Most foreign buyers think the unit will be rented for 12 months, a year. They can list it and someone will just come take it. They also only calculate gross rent in their ROI, which is the most ridiculous one. Reality is that there is vacancy between the tenancies as well, and this equals lost income. If one tenant moves out and you're not finding the next one, there might be 1 month, 2 months, and even longer between the tenancies. And you are looking for a long-term tenant while you don't want to do the Airbnb short-term. So you're actually in between that very weird situation where you're supposed, or at least you're forced to lose some income. Agents will take their time to fill it, and it could take quite long. And every single month that you're losing income is going to decrease your annual return by 8, 10%, or even more. From experience, I'd say as a tip, always budget for about 2 months of potential vacancy if you're doing long-term rental, especially in your first year. Because first of all, you'll need 1 month to either furnish it or check the snagging, do all the inspections to make sure that the unit is ready for rental, and then you might have this another month in between vacancies at the end of the year. Nevertheless, if you're buying in Dubai from abroad, I admire you because I did the same thing. I was scared a lot, and it took some bravery to actually investigate a potentially completely new market, which means that you're thinking long term, and I like that. And you're thinking and betting on a growing market, which is also admirable. But don't let that excitement blind you to the small details that can create massive losses later on. Nevertheless, if you found this video useful and helpful, as always, leave a thumbs up, subscribe, and leave your comments below. Let me know what you think about this process, if you've been through it. If you need any help, reach out to me, book a one-to-one call directly with me, and hopefully we can get your journey in Dubai started or just help you expand your portfolio and grow it fruitfully in the region. And with that, I will see you in the next one.